In this video, we will explain what a bond is and how they actually work so that you can confidently protect your money, generate steady income, and stop relying solely on the wild roller coaster of the stock market. Let's get into it. Alright, here's a quick overview of what we'll cover today. First, we will define exactly what a bond is in plain English. Then, we'll decode the key terms you need to know so you don't get lost in financial jargon. After that, we'll break down the different types of bonds available, from government to corporate. And finally, we'll weigh the pros and cons, including the real risks involved, so you can decide if they actually make sense for your financial goals. The basics. What exactly is a bond? A lot of people feel completely overwhelmed when they hear the word bond. You might be thinking it's just something rich people in suits talk about, or maybe James Bond is the only bond you're really familiar with. But honestly, a bond is just an IOU. Yeah, it's really that simple. When you buy a bond, you're lending your money to an entity. That entity could be the government, a city, or a big corporation. In exchange for handing over your hard-earned cash, they promise to pay you back your original amount on a specific date in the future. Plus, they pay you a little extra as a thank you for the loan, which is the interest. So unlike a stock where you buy a tiny piece of ownership in a company and cross your fingers that the price goes up, with a bond, you are the lender. You're essentially acting like the bank. You know exactly what you're supposed to get paid and when. But before you run out and lend all your money to a random company, there are a few moving parts you need to understand. Stick around, because in the next section, I'll decode exactly what those moving parts are so you don't get taken advantage of. Decoding the jargon. Key bond terms you need to know. Okay, now let's decode some of the financial jargon you have probably heard thrown around. Financial experts love to use big words to make things sound complicated, but we're going to keep it easy to understand. First up is the principal, which is also called face value. This is simply the amount of money you are lending. If you buy a $1,000 bond, your principal is $1,000. Next is the maturity date. This is the exact date when the borrower has to give you your principal back. It could be 1 month, 1 year, or even 30 years from now. Then we have the coupon rate. I know, it sounds like something you'd use at the grocery store to save 50 cents on cereal. But in bond terms, the coupon rate is the annual interest rate the issuer pays you. If you have a $1,000 bond with a 5% coupon rate, you get $50 a year. Simple as that. Lastly, there is yield. Yield is essentially your actual return on investment, which can change depending on what you paid for the bond if you bought it from another investor instead of directly from the issuer. By the way, if you're getting value out of this video, hit like, subscribe, and tap the notification bell to get more valuable content like this. Stick around, because up next we'll dive into the bond buffet, and I'll reveal which specific types of bonds can actually earn you tax-free money. The bond buffet, different types of bonds. Alright, so who exactly are you lending your money to? There are a few main types of bonds, and they all have totally different risk levels. First, we have U.S. Treasury bonds. These are issued by the federal government. You've probably heard of T-bills, which stands for Treasury bills. Those are just short-term government bonds. Treasuries are generally considered the safest bonds in the world because they are backed by the United States government. If the government can't pay you back, well, we probably have bigger problems on our hands than your investment portfolio. Next, we have municipal bonds, often called munis for short. These are issued by states, cities, or counties to fund public projects like schools, hospitals, or highways. The really cool thing about munis is that the interest you earn is often tax-free at the federal level, and sometimes at the state level too. Then we have corporate bonds. This is when companies like Apple or Ford need to raise cash to build a new factory or launch a product. Because a corporation is more likely to go bankrupt than the federal government, corporate bonds usually offer a higher coupon rate to make up for taking on that extra risk. There are also high-yield bonds, commonly known in the industry as junk bonds. These are issued by companies with shaky credit histories. They pay really high interest, but there is a much bigger risk that they might default and leave you empty-handed. Keep watching, because in the next section, we'll tackle the biggest frustration of all, which is the hidden ways you can actually lose money on these so-called safe investments. The real risks. Are bonds actually safe? A huge frustration for a lot of investors is the deep fear of losing money. You might constantly hear that bonds are the safe part of your portfolio, the anchor to keep things steady when the stock market is crashing. And while they are generally less volatile than stocks, they aren't completely risk-free. Let's look at all the angles here so you don't get blindsided. The first big risk is default risk. This means the company or government you lent money to goes broke and simply cannot pay you back. That is exactly why credit ratings exist. Agencies like Standard & Poor's, or S&P for short, give bonds a grade. A rating of AAA is top tier and super safe, while a C rating means you're basically gambling. Then there is interest rate risk. This trips a lot of people up, so pay attention. If you buy a bond paying 3% and next year the market interest rates go up to 5%, your 3% bond is suddenly completely unappealing to other buyers. If you need to sell your bond before the maturity date to get your cash, you'll have to sell it at a steep discount, meaning you lose money. It is a seesaw effect. When interest rates go up, bond prices go down. Finally, there's inflation risk. If your bond pays 4% a year, but inflation is running high at 6%, your money is actually losing purchasing power over time. Even though your balance is growing, you can buy less stuff with it. So while bonds provide steady, predictable income, they aren't a magical shield against all financial dangers. So let's summarize what we covered today. We defined what a bond is, which is basically an IOU, where you get to act as the bank. We broke down key terms like principal, maturity date, and coupon rate, so you can speak the language of finance. We explored the different flavors of bonds, from super safe treasuries and tax-free munis to risky corporate junk bonds. And we looked at the real risks involved, like interest rate fluctuations and inflation. For you, this means you now have the tools to look beyond just the stock market. You can use bonds to balance your portfolio, generate a predictable stream of income, and sleep a little better at night, knowing you aren't completely at the mercy of sudden stock market crashes. Just a very brief disclaimer. I am not a financial advisor, and this video is strictly for educational purposes. Always do your own research or consult a professional before investing your money. If you want to keep learning, check out this video next. Thanks for watching, and I'll see you in the next video.